Good morning, everyone. Welcome to the ESG panel, the most exciting channel. I always say that because I love ESG. It's important. Thank you very much. So my name is Jenny Bai. I'm professor of finance from McDonald School of Business, Georgetown University. I'm also research associate from the National Bureau of Economic Research. So my newest research field in ESG field, including a new paper on the global carbon trading market. So last year, I hosted the ESG panel online, and very happy today, this year, we can welcome people in person. Today, we have three fantastic speakers and magnificent moderators. So who are they? They are Joe Amato. So Joe is the president of Neuberger Berman and also the chief investment officer of equities, also overseeing the firm's fixed income business. Before that, Joe was Lehman Brothers global head of asset management. So we want to always mention Joe is received a bachelor degree from Georgetown University. Welcome home. And Joe currently serves at Georgetown University's Board of Regents and McDonald School Business Board of Advisors. Our second speaker is Sam Hodas, the managing director in TIAA Nuven Investment. His expertise especially on the ESG part. He is the head of enterprise ESG strategy. Welcome. And our third speaker is Anand Madhavan, managing director from BlackRock. So Anand is most famous for his works or for his book on ETF and index investing. A few years ago, he was here for our annual conference, particularly themed on ETFs. And he was the global head of research for BlackRock's ETF division before. Welcome back again, Alan. Yeah. So lastly, we have this magnificent moderator, which is Asfani Beshlas, founder and CEO of Rock Creek. So Asfani was a partner of Carlyle before her new job in the Rock Creek and MD at JP Morgan. She also works in Shell International. Asfani is probably most known for her a lot of contributions and work at the World Bank. There, he led the World Bank's energy investment and policy work on sustainable investing. And in 2020, she was named as Barron 100 most influential women in US finance by American Banker, one of the 25 most powerful women in finance. And we are very happy, very gladly, she's also in Georgetown University's Board of Advisors. Thank you very much. We're looking forward to an exciting panel.
Jenny, thank you for that incredibly kind introduction, and many thanks to Rina and everybody else at Georgetown. Very honored to be part of the Georgetown family and to be with all of you today. And particularly at the SARS Center, because this is, I think, one of the first times I've been back in Georgetown in person, and it is just so different. It is such a different experience to be together and to be able to not just have the session, but to really talk to each other and be able to hopefully over lunch, share ideas and collaborate. You have given us a difficult task, but a really interesting task, Jenny, because it's really interesting at this time to be talking about ESG. It is in the newspapers. Sometimes ESG is like a bad word. I remember at one point I ran the bank's derivatives business, and D was for like a dirty word. So ESG, which I grew up, as you said, at the World Bank thinking that, E and S and G were all good words. Having good governance is good. Being conscious of your environmental and social impact is a good thing. So for the last, 20, 30 years, it's something that has become second nature. And I think there is just so much potential for it, while there has obviously also been two forces. One is regulators trying to make sure that we're protected against the wrong kind of advertising about ESG. At the same time, I think there is too much kind of negative vibe personally. And I'm very excited to be talking to this incredibly experienced panel, because you all are involved in some of the biggest institutions globally. investing across the board, including in ESG. And each of you has personally also been leaders in ESG yourselves in your careers. And while we see these big numbers, for example, 2.5 trillion in ESG assets, I wouldn't believe those numbers because that's kind of a little larger probably than life. I think the numbers are much smaller, but they're fast increasing. And I think the two data points that I'd like to sort of start with as we go to the panel. One is that while the numbers are small, they're the fastest growing. As you know, there's a lot been, because of the markets being where they are, we have highest epical dollar in many, many years. We have inflation being where it is. We have at the same time, the war with Ukraine has been invaded by Russia. And we have the big challenge of climate and a lot of other issues around equity all over the world. So there's a lot going on. Every morning that we get up, you have the British LDI blowing up that could mess up the whole world. And at the same time as all of this is going on and some assets are being taken out of the market, actually ESG assets are either flowing in or flowing out much less. Number two, everybody's saying, why bother with, let's say, renewable energy? Because, look at oil and gas, they're up. So if you're a fiduciary, oil and gas are up more than renewable energy. Well, if you look in the last 12 months, yes. But if you look at actually the last 3 years or the last 5 years, the ETFs, some of which you all also sponsor, for renewables are higher than oil and gas. And probably looking forward, they will be even higher. So when we look at data, I think it's really important to note that ESG probably is going to, in our lifetimes, be the fastest growing area. And so that is why I'm particularly excited to be moderating this panel. Joe, if I could start with you, do you think that market participants and the regulators are on the same page with ESG definitions? What about lawmakers?
Well, first off, I'd like to thank everybody for being here. It's exciting to see such an extraordinary event for the Soros Center. I'm honored to be on the board. Thank you, Rena, Mike, an incredible, generous, transformational gift to the center. So I'm looking forward to the great things that we can do. And I think this question that you ask is a good example of the opportunities for the center to sort of clarify a lot of sort of conflation of issues that unfortunately we've been in the middle of. ESG has now become a bit of a political football. And ESG has become a sort of amalgamation of a series of different issues that are very different. So I'll tell you how I define it, at least, or we define it in our firm. ESG integrated is the incorporation of financially material factors among many, many, many other factors in an investment process. It's about process. It's not about imposing one's values on how you're running portfolios, right? That's good investment decision-making, right? If you're looking at, what's a good example? If you're looking at General Motors, you would be irresponsible if you didn't consider their strategy in electric vehicles. Okay, you just considered an E factor, okay? You would be irresponsible if you didn't understand what their relationship is with their labor unions. That's an S factor, right? So there you've just had an integrated ESG investment decision-making. You can't mistake it with sustainability and impact investing and exclusions, which are about outcomes. That's about seeking outcomes that are whatever the goal of the particular client or investment strategy is, right? Sustainable is weighing very heavily those ESG factors as being the dominant decision-making. Impact is about achieving positive outcomes in social and people on the planet, right? Exclusions is accommodating clients who don't want to invest in certain types of companies, nuclear, defense, certain kinds of healthcare, what have you, right? Those are just very different than ESG. And the political process, the political football is putting all these things together. When you read editorials or you see initiatives out of state legislatures, they're just, they're not doing justice to the issue. And I think we can all clarify that in a way and being very specific about what you're talking about. Even as you described ESG assets, is that ESG integrated assets? Is that sustainable assets? Is that impact assets? They're very different things. So sorry to go off on that, but it's a hugely important point.
Absolutely. Thank you for that. And I think, as you said, it's a lot in the newspapers right now because it's become a political kind of football versus otherwise. And I think one of the things, at least observing it for myself, some of the states that are talking about the political aspect of things are some of the biggest investors, in fact, in solar and in wind, if not the largest in wind. So there's.
Can I add one thing?
Please.
ESG integrated, that first category I described, is completely consistent with being a fiduciary and seeking the best returns for your clients.
Thank you for that.
So that's really important component of it.
It's good risk management. So if we could go to Anant, I'm just curious to know, Anant, what you think in the research on ESG that you do. Is there a growing or weakening emphasis on climate? And when it comes to social issues, what are the trends that you're seeing at the moment?
So, I will echo Joe in thanking the Soros Center for inviting me and thanking Rena. So it's great to be back. So great to see this crowd. In terms of your question, very clearly, I will frame it the way Joe did. I really liked his framing. So I think he talked about process. I'll talk about data. And I think at the end of the day, ESG has been around in various forms with different monikers for many decades. And it actually goes back, some of the exclusions date back to the 60s. They've been different labels like socially responsible investing and the like. But increasingly what we've seen is that there's urgency around climate change, and the amount and quality of the data has greatly increased. And that's some of the confusion that Joe alluded to, is because you've seen the stakes get higher, and you've also seen at the same time the complexity of what's being made available to asset managers and to clients and the like has grown exponentially. So climate, to your question, I think obviously, when we talk about emissions, that's a climate, that's a planet-wide thing. But more climate questions are local. And so what we're seeing is we have to be cognizant of local issues, pollution in a local environment, in particular countries around cities, those kinds of things. And that data is becoming more granular, and it's getting wider coverage, and it is better quality. Turning to the social question, I think this is a little harder because the climate data are sort of fact-based in some sense, and they come from science. And the social data are more constructs, of people. And so I think that's where we'll see some evolution. But again, we're seeing a lot more metrics than we did even a few years ago, in terms of all of these data points.
I think for those who are students in the crowd, one of the biggest businesses is the businesses that are around the measurement of ESG right now. I have never seen more carbon trading, but specifically measurement across all the ESG metrics. It's just booming, and not many people who can do it or who have the expertise.
Our friend Henry Fernandez, Georgetown graduate, runs the MSCI. He's making a killing.
We should put a plug for Henry, absolutely, of course. Not that he needs one, but so if I could go on to Sam, the idea of ESG has been around for a couple of decades, and the earlier focus was on the G, because that was sort of, I don't want to say easier, but there was a lot of things that were relatively easier to measure. But lately, much of the focus has shifted to E and S. And as we heard, the E is maybe in some ways easier to measure, the S is more complicated. And obviously climate as part of the E. Does it make sense to keep ESG as an umbrella term? Or should we disaggregate? And where do you see the emphasis over the next couple of years?
Yeah, getting back to sort of how we started this conversation, and also, first of all, thank you to Georgetown for having me here. But there's still, I think, a lot of confusion about where ESG shows up in the investment process, and then how that differs from where it shows up in products. We've seen sort of ESG should be really a noun, right? These are the factors. We've seen it kind of transition into a verb, and then in some quarters, it's become the newest 4-letter word with only 3 letters. So in terms of disaggregating it, I think what we're seeing with so much focus on climate and now this pivot towards inclusive growth and social issues is that investors and asset managers are trying to find products that can be more cleanly siloed within the E, the S, and the G, or sort of G riding underneath all of it. Obviously, we've all for a long time engaged with investee companies to talk about, board quality and diversity issues, executive compensation, those sorts of things. But I think there's going to be a more enduring and clearer trend towards differentiating what the actual products and solutions are and how they relate to specific themes versus just saying, well, this is an ESG fund. So, throw it in and know that we consider ESG factors or have specific inclusion or exclusionary screens, that govern the entirety of it.
If we could go back to you and, if we could talk about performance. We talked about the MSCI factors, but how should investors, traders, asset managers look at ESG as a risk mitigator or as a return generator? And what does academic research tell us about the link between ESG and performance historically? Would love to hear from you on that. And if you could answer those.
Sure. No,
those are that's
how many-
a lot of material.
How many hours do we have left?
We have a couple, I think, right? So we can go for lunch.
No, but as a financial economist and as a recovering academic,
I like that.
let me give you a somewhat detailed answer. Okay, so I think it's useful to think about the past and the present. So you asked a question about, is it return or is it risk? I would say that there's, it's potentially both. The evidence is mixed, and partly that's because the data is sparse. We don't have a lot of long time series. People look at different measures of performance. So you can think about investment performance and alpha, or you can think about operating performance, how well a company is run. What we do know is that there have been a ton of academic studies, and one of my more interesting reads recently was a study out of NYU by Ulrich Axt, AXT, 2021 study. Axt and his co-authors did a meta study. So they actually surveyed over 1,000 academic papers written from the 70s onwards about the link between various ESG metrics and performance, either operating or investment performance. What do they find? Well, of course, they categorize the academic research into positive outcomes, negative outcomes, mixed outcomes, neutral outcomes. And what they found was actually quite interesting. There were a few negatives, but there are many more positives than negatives. There was also, as you'd expect, with different researchers looking at different time periods and using different methodologies, quite a bit of sort of mixed messages. But clearly, they came up with this conclusion. I think the other thing that was very interesting about what they found was that as you expand the window, the time horizon over which you do this research, the positives start to dominate more. So maybe these are effects that take a long time in terms of investment performance. The risk mitigation story, I think, is also very plausible. I mean, these are plausible things. And then lastly, I'll say this is looking in the rearview mirror, and it's a time when ESG investing was not big. If you look forward, you talked about the flows, and those flows may have price effects. So there's some recent work by Ralph Koyen on demand-based asset pricing. It's a great, he and his co-authors have done some great work, academic work on this. And if you believe that story, then the flows may have some price effects as well. So the forward-looking scenario may be different from the rear. Yeah, exactly.
And you see much more effort towards sort of gathering the data on performance?
Well, I think it's, as I said, touching on Joe's comments, we are seeing a lot more interest in the granular data. People are looking at various metrics. I think on the alpha side of things, my colleagues who are trying to beat various benchmarks that the client picks are looking at these alternative data sources, and they're doing back tests and trying to see if this can predict returns. So it's very much top of mind for alpha generators. And also to to my colleagues here on the panel, I mean, I think we are also on the index side of things, looking at the more granular data to build vehicles that better fit the client's needs. So the clients, some clients are doing impact investing, some are looking at ESG metrics as a way of mitigating risk. Some of them think it's a return factor. Some of them, have dictates, from their ultimate owners about things like alcohol and tobacco. They don't want to be in that, and so, you see a big spectrum, and you have to have the data to actually build those products for the clients.
I think, as Joe said, it's if you're a good investor, you have to look at these factors. It's just part of your analysis, and it's
Fiduciary
not
duty.
good. Exactly, it is your
Fiduciary duty.
fiduciary duty, and it is a big risk if you don't look at many of these things.
Yep.
Joe, if we could go on to sort of the whole issue of regulation, obviously, Gary Gensler has been very active
Is
on
it
this
still
front.
on? I just want to make sure.
I think it's gone. I think it's gone. We've seen the gap, obviously, between Europe and here, the US, in terms of ESG issues. Do you find that the gap between the two problematic? How do you see it, and how do you work around it?
I think the regulatory frameworks in lots of different parts of the world present huge challenges for asset managers because the approach is quite different. In the US, there's really two major regulations Gary referenced. I think both of them. One is, lack of a better term, the names rule, right? And bucketing strategies in ESG integrated, sustainable, and impact, right? You can only use the ESG name on the latter two categories as an example. We've provided comment letters, but generally that's a thrust is positive, and it's more oriented toward what I described earlier about process, clarity of process. In Europe in particular, you may have heard of SFDR, the Sustainable Financial Disclosure Regulation, right? It's not just about financial materiality. I would describe it as double materiality. It's financial materiality plus the material impact, particularly on the planet, right? The real world outcomes, right? So that has created a monstrous set of regulations that are more about outcomes. So it goes back to my, discriminating between process and outcome. So Europe's taken a much more outcome approach, almost forcing capital to be invested in a particular manner. And on top of that, you have one-upsmanship being played by all the different countries. So you might have SFDR, and then the Germans are putting additional framework, and the French are doing this, and the Belgians are doing that, and so it presents a real challenge. And we've encouraged regulators getting to the second SEC regulation around emissions to be more on the same page and have a level of consistency across regulatory frameworks, at least as it relates to elements of disclosure. But it has created an enormous set of challenges. We've devoted tons of resources to it. And it probably, in Europe, you don't have the political football that you have here in the US. So Europe, in a sense, they're all in on this. And so we don't expect any major change in the thrust. Hopefully the regulators in Europe will provide clarity. It seems like the goalposts keep moving, as they provide more guidance, and that has created challenges. But it is a massive, massive regulatory thrust on the part of the Europeans.
So it's more massive there, but the direction is one direction, whereas here, the direction can change.
The issue is the politics. So if I see a client in Texas, they'll tell you, like, do not mention the word ESG in our discussion. They've requested information from lots of asset managers, like about, are you boycotting fossil fuels? And they create the naughty list if you're boycotting fossil fuels, where they think you are. You go to a client in California, it's a very different discussion. In Europe, it's more consistent for sure.
So Sam, if you could come back to you, as companies are increasing their ESG disclosures, as you're talking about, there will be more non-financial reporting also by the companies. And I was just saying there's big business in the metrics companies, but with no standard metrics today, investors are really concerned about reporting ESG disclosures, when they get audited, when they get verified. How do you see the issue of ESG metrics and verification playing out?
Yeah, to building off of what Joe was discussing here with the different regulatory regimes around ESG product characterization and ESG integration characterization between the US and the EU, you know, they're sort of slowly starting to move in the same direction in the US, at least at the federal level for the time being. And you know, in pushing in the US to have operating companies start to disclose their scope 1 and scope 2, and in some instances scope 3 emissions, there's been some discussion by the regulators about whether or not that data should be audited and assured in some way. And you know, our view is that this is a big undertaking. You know, we need high quality, comparable and consistent data. You know, we utilize a lot of different, you know, alternative data sources, AI, other things to try to bring together the right mix to make good investment decisions. But at the end of the day, having this baseline is going to be critical to really, you know, taking our ESG investment practices to where we need them to go as an industry. And our view has been, one, it's very important to get the sequencing of this right. One of the things that happened in Europe was that we saw them move forward with their taxonomy, with the SFDR regulations, and then coming on the caboose of that was disclosure regulations for operating companies. And we think it's very important that you have the data made available, allow the investors to analyze, incorporate, understand that data, and then we can start moving towards greater transparency in terms of fund disclosures, because obviously our scope 3 emissions are the investee scope 1 and 2 emissions. And then when it comes to assurance and auditing, you know, this is a new regime, and it's a big new regime, and there has to be space and awareness of that. We need to make sure that those companies that are on the front lines that we're asking to do this heavy lifting right out of the gate have the time to understand what it will take for them to provide their climate emissions data. For those who are going to do the scope 3 emissions data, they need time to, again, go through their supply chains and understand how to gather all of that. And so we think that process needs to play out. We need to see what type of data is getting provided. Again, what is the quality? Where are the gaps? Before we would then move forward with a more assertive regulatory structure that would require auditing. So let's move in this direction. But you know, there's no need to do things that could end up creating more noise in the interim.
Thank you. So if we could go to you, Anand, in terms of the optimal role of disclosures, both to allow investors to verify impact across ESG categories and to best position investment managers to maximize return for investors, what do you recommend?
Well, it's a great question. I think, you know, to touch on the previous comments by Joe, I think this is a work in progress. There is clearly a demand from the asset managers and the index providers who create these indices for more detailed data. I think to Joe's point about, you know, the belief that in acting as a fiduciary, for the asset managers acting as a fiduciary, and they need to consider whether these data are material or not. And if they are material, then there should be some, you know, regulation around that. I think that's where we're going to wind up going. And again, you know, we've put on comment letters about all of this, so I don't have a lot of time to go into this in detail, but I will just say there's a ton of information that we have put out about our views on this and how it should evolve.
We all know, I think, being in the business, that these measurements can lead you to very different results in terms of a particular company or business. So coming back to you, Joe, if I could ask you, what do you see as the biggest pitfalls to the various sites and their emphasis or non-emphasis on climate disclosure? You touched on this a little earlier. And does that put market participants in the middle of a philosophical and political debate? You've already touched on some of this, but
yeah, I think regulators, folks down at the end of Pennsylvania Avenue, you know, need to understand the subtleties of what we're talking about and not, you know, group things together that are, you know, should be separated. And you also have the dynamic that, you know, if you look at the Department of Labor. So we manage a lot of pension assets for corporate public plans, right? You're bound by ERISA, very, very stringent regulation. The guidance from the DOL changed essentially 180 degrees when it was under, the Trump administration versus the Obama administration, now back to the Biden administration. So you feel like you're being spun around when it was like you should, ESG is fine to use in consideration. Understanding the financial materiality issue, then it became you can't use ESG. You can't. And then, it's reversed again. So, and that's just the DOL, you're not even talking about the SEC or, what may come out of individual states. So there's 19 states that right now are proposing legislation that would almost ban the use of ESG factors. And again, when you read the fine print, they recognize that financial material factor should be considered, but it's still becoming a four-letter word, right? In the context of, and it's going to become an even bigger political football. So we're sort of in the middle of that, and it's frustrating. And I don't really see it ending, because I think those politicians and groups of folks that have made a big deal out of this see it plays well, on certain main streets, and so I think they're going to continue to pound on our industry. And our advice to whether it's the firms represented here or others is to let's just keep our heads down and just do good fundamental work, and stay out of the op-ed columns.
It is tricky though, because good fundamental work does include this now. So it's kind of, as you said. So Sam, we've, as Joe said, with the regulators also coming down in different ways on the companies, one day for greenwashing, one day for not mentioning these words. Where do you see this going? And, as Joe was just saying, do you think that conversation that's going on in more conservative states will fundamentally, as you suggested, change things? One other question I have, since we're at Georgetown University, the next generation that is becoming investors has very different views, regardless of whether they're conservative or liberal or moderate or somewhere in between. How are you planning for that?
Yeah, it's a great question. I think what we're seeing is, globally and even here in the United States, institutional investors continue to look for and prioritize ESG as part of their overall strategy and investment mix. I'll say on some of the retail channels that we support, we see this bubbling up. We see it coming up. People want to see it on their retirement plan menus. Folks want to see it be provided to them by their advisors. Like there's a groundswell of demand that isn't necessarily reflected in the rhetoric that takes place in state house offices around the country. I think that one place where we'll likely see some potential alignment between the ESG skeptics and those who are really championing ESG is in the transparency. The demand for managers to be more transparent in, how you're using ESG, what your sustainability goals are, what your impact goals are. I think those things are only going to increase. And hopefully in speaking to those who are more skeptical about it, it'll give them, more comfort that this is just fundamental to the investment process. All of us invest in the real economy at a global scale, and we can't ignore things just because there are disagreements about, whether this is, climate change is real or not. We've made our assessment, and we have to invest based on what we perceive the risks to be. So hopefully as there's increased availability of data, increased transparency, it can help to alleviate some of the concerns and take the temperature down a little bit, because we can talk about, again, fundamental investment processes versus political goals, social goals, which really aren't or shouldn't be part of this conversation.
It's very interesting. I was recently at the conference in Texas, and as all these conversations were starting, and what was really inspiring was that there were some of the biggest investors, some politicians, policymakers, and heads of companies. But the person who'd organized this was the CIO of a major entity that you would all know, and like his board chair was the CEO of a major exploration production company. There were lots of people present from the oil industry, and if you sat in small rooms with them, all of them said that the biggest opportunity they see is in renewable energy. They did not say whether they believed in climate change or they didn't. All they said was that biggest opportunity set is in climate-related investments, because that's where resources are going. That's, look at the big government, the Inflation Act with 370 billion going, which is the biggest ever in this area. So for them, it was purely an issue of investment. And all they were complaining about is, why is the permitting so slow? So it was the exact opposite, but we don't read about those in the newspapers, right? And these were the same people who said, I don't want you to touch my oil and gas, just leave it there. But my new dollars are all going to renewable energy. So that was kind of interesting. But if we could now go on to questions from the audience, if you could say your name and if you could come to, I think we have some microphones here for questions. So please go ahead.
All right. Name is Roku Yang. When you were talking about ESG integration at the beginning, with the car company example and all, just as a clarification question, isn't that just like business as usual, but with clever marketing? And in a way, this would also speak to, the question about whether if there's a relationship between ESG and financial performance, because if we don't really know what ESG is, if it's sometimes it's clever marketing, then that can lead to spurious correlations with financial performance.
Well, it's that directed to me. I do think that we didn't really, I think, Sam, you might mention greenwashing or that's clearly an issue regulators should be focused on, which is claiming you're doing certain things and you're actually not doing certain things. What the point I was making is the distinction of looking at financially material factors such as environmental, social, and governance, again, along with many, many other factors in the context of making good investments. That's not in a strategy we label ESG per se, right? We are very clear that if you want to invest in a sustainable strategy, that's very different than what an ESG strategy is. But, that's again, the conflation of these issues that I think creates, and why some have gotten, criticized about greenwashing. Because if you go back, we were sitting here 2 or 3 years ago, 3, 4, 5 years ago, the trend was very aggressive that, we knew this was coming. And there are a lot of folks in our business that were all in devoting, many more resources to it. And, you sort of now have the other side of it.
Should we go back and forth here?
Hi, my name's AJ DeGrado. I'm a senior finance major here at Georgetown. And I was just curious, it seemed like a lot of our discussion focused mostly on Western countries, so the US and also Europe when it comes to ESG investing. As like global asset managers, have you guys looked at any opportunities in emerging markets when it comes to ESG? And if not, what are some of the barriers?
I guess I would say, certainly from a regulatory perspective, we're tracking developments all over the world as we see new stewardship codes and requirements pop up. In terms of investing, from an impact perspective, there are lots of opportunities that present themselves in emerging markets, and it's something that we're very focused on as a firm. And so I would expect to see continued attention and growth in those areas.
Yeah, and let me just add a great question, AJ. I will also add in terms of you asked about the impediments and what's hard. What's hard about it is, again, I keep harping on data, but the best reporting comes from the Western countries, from the bigger firms in the Western countries. There is a sample selection bias which is present, and that's slowly getting better over time. But that's one of the challenges we face in trying to do this in the emerging market space.
I know I don't want to pile on too much, but I think the call elephant in the room is China when it comes to the emerging world and the context of how you think about ESG. And our view on China is engagement is important. There's no way you're going to achieve the climate goals that we collectively probably all want to achieve without a level of engagement and understanding of the processes going on in China. And I would add India to that, because, their emissions are in fact going to peak, right? The use of coal is going to increase certain these countries because they just have to from a energy producing standpoint. So it presents a real challenge when you think about the broader goals. And like you said, there's a lot of focus on Europe and US, but we need to understand what's going on in India and China.
Good morning. I'm Luke Musser. Thank you all for being here today. So the last 4 or 5 years, there's been a lot of action in the ESG space, but more so, I would say there's been a lot of pledges towards meeting ESG metrics. And recently, for instance, like Sierra Club criticized a lot of utilities for their shortcomings. And when you all are looking at whether groups and companies, how do you factor in when a company seeks a lot of its credibility in the ESG space from pledges that have yet to be met?
Can I just say one thing on that? Because the World Bank IMF meetings are on. That's why traffic is so bad in our city. And the number of conferences and speeches and, the fans and net zero and hundreds of places you sign up to say as asset managers that we are all moving into net zero is huge, right? But you're absolutely right. And especially for your next, your generation, unfortunately, people are talking a lot and doing very little. So I think it's actually interesting that private sector asset managers are doing it because they're listening to you, because we have to listen to you. Otherwise, you wouldn't buy our products.
Well, I can dive in on that. I think as it relates to engagement with companies, if what you're referencing is sort of really related, it sounds like to net zero and a transition pathway, and whether companies are going to achieve net zero, which is generally 50% reduction in emissions by 2030 and zero by 2050, which is an extraordinarily difficult set of goals to achieve. But there are metrics, and we are engaging with companies, particularly science-based target initiatives, where you look for a company, and that's why, as my colleagues have said, disclosure is so important in understanding what's going on in the context of that transition pathway. But it's going to be that's a good example again of something that probably shouldn't be conflated necessarily ESG. To me, it's just different, right? If you want net zero, okay, net zero and have a commitment. And then the last piece is, while many of our industry have committed to net zero, which is an aspirational goal. It's not, we're not forcing a client to invest in companies that are consistent with net zero, have a transition pathway. But the absence here is government, right? If governments aren't going to get, are not going to have a tax on carbon, we're just not going to succeed in whatever transition pathway a utility or some other company might try to achieve.
Great.
Oh, no, I think obviously Joe covered it well, in terms of holding folks, I don't want to say accountable, but, when we engage with them through our stewardship operations and our corporate engagement, our proxy voting, like what we want to know is, what is your plan? What is your strategy? And then what progress are you making against that plan and that strategy? And it helps us obviously, understand where they are on against their commitments that they've made. And it helps us obviously get more data and more information. And then I'll say, speaking for TIR parent, we've made a commitment to be net zero carbon in the general account that supports our core retirement products by 2050. And we appreciate that 2050 is still a number. It's very fast when you're talking about a net zero pathway, but it's still a number of years away. And so we're trying to be very clear and transparent in our annual reporting about what our intermediate targets are and how we're going to get there, because we appreciate that you can't just throw a number or a date out there and just say, call us in 2050 and we'll let you know how it all worked out.
Maybe we'll go to another question.
Hi, I'm Andreas Moeller. I'm a sophomore in the McDonough School of Business. So in an effort to kind of decarbonize and meet their ESG goals, I know a number of companies have begun to turn towards hydrogen and the hydrogen trading market as a solution. Now, my understanding is the hydrogen trading market has been on a trend of continuous growth, but moderate growth in terms of its value globally. And a large part of that is associated with the high cost of producing green hydrogen. However, obviously, as you all spoke about, there's been a large push for greener and cleaner energy. And so I was wondering if you see a potential for high growth in the hydrogen trading market. And if so, what do you think its implications are for ESG and the overall global market?
Great.
I mean, I can't speak to the hydrogen market specifically, I will say with the passage of the Inflation Reduction Act, as we were commenting earlier, it included a substantial, a historic amount of funding for investments in new clean energy technologies. And I think our expectation is that as that money is deployed, as new companies come to market with technologies that can sequester carbon directly from the atmosphere, provide clean sources of power in a much more scaled and low cost way, that we will see lots of energy and excitement in investing in those carbon solutions or climate solutions moving forward.
I would, Anas, please.
Yeah, so I'll add to Joe's comments. I mean, I think the pace of technological innovation has been so rapid. I mean, look, I mean, when I grew up, there were no iPhones. It was, you wanted to go somewhere, you'd get a physical map and you'd draw your route and you'd write it down. And now it's also easy. So I think that this is a personal view, but I think that the pace of technological innovation will surprise us. I think we're getting very close on nuclear fusion. It's been many decades, but there are private companies now launching to do this, and that's a good sign that scientists and engineers feel we're close, and that could be transformational. So I don't know what the future will hold, but I remain optimistic.
So unfortunately, this was our last question that we can answer. We're all here. All of you who are in line to ask questions and others in the audience who haven't got a chance, please come up to us, because I think we're between this panel and lunch, and we don't want lunch to be late. But let me thank Sam very much, and Joe very much, and Anand very much. So
Thank you.
for this great discussion. Thank you.